Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Hurd, Senior Portfolio Manager at State Street Global Advisors, for his 2022 outlook on global currency. Aaron, it's great to have you with us. Welcome to Trade Talks.
Well, thank you for having me.
You got it. And let's start with an overview of currency trends that you noticed in 2021.
Yeah, 2021 was obviously a difficult year, right? Driven by COVID, right? And in the end, we can see now with 11 months of hindsight that the dollar did quite well, Canadian dollar did quite well, sterling did quite well, British pound. If you look at the common factors underlying that, it really comes down to the resiliency and flexibility of those countries in dealing with COVID, right? So if we go through the year, I think the first half of the year was pretty straightforward. Everyone had very high hopes that the vaccines would really put the pandemic behind us quickly, right? So we thought the dollar was a bit oversold. The U.S. economy was set to rebound pretty strongly as the U.S. led the world in vaccinations along with the U.K. And that worked out in Q1, right? So it was all about the vaccine leaders. So you buy the U.K., you buy the U.S. dollar. Then in Q2, you switch and you go to the next round of winners, right? As vaccines ramp up. So you buy the euro, you buy EM, you get into some of the commodity currencies. But as we got into the middle and end of Q2, we saw Delta, right? Delta variant started to overtake the world and complicated matters quite a bit. So there we started to look at the impacts on inflation, higher for longer. Central banks being squeezed, which central banks had the flexibility to react properly. And it became a much more positive environment once again, as it was in Q1 for the dollar, because the US had proven capable of handling the successive waves of COVID. And the Fed began to move their dots back in June, to signify a rate cut in 2023. Right, so you saw the dollar take off again, EM currency and some of the riskier currencies that weren't as able and flexible to deal with the potential disruptions of Delta start to sell off, right? And that really has been, the environment since then. And obviously with Omicron coming on the scene a week and a half ago, it's gotten even worse. The one caveat in there was commodities have been strong. And we've been pleasantly surprised with the ability of economies to grow through the pandemic, right? Even the economies that are more challenged in terms of lockdowns and so forth, right? So consumer demand has held up better. That's supported commodities, big correction the last week, but that's helped some of the commodity currencies like Norway, Canada, and so forth.
So what's your current currency macro view heading into 2022 and for the year?
Yeah, well, unfortunately, and with Omicron, it's still this messy transition from pandemic to endemic, right? The jury's still out on Omicron. We have to get a lot more information. Hopefully, it's not too bad, right? Maybe spreads a bit more easily than Delta, but hopefully, in the best case, is more mild. But we have to wait and see, right? So right now we have that uncertainty, and we're reminded of the fact there could be additional variants in the future, right? And we're going to have to deal with this variant. And so again, we're going to stay with that same theme where, we're looking to resilience in the face of these ongoing waves of COVID. But we do see, again, a shift from pandemic to endemic. So gradual improvement over time, thanks to vaccines and modifications to those vaccines and so forth. That means along with excess savings, really fiscal stimulus from last year and from 2020 that still has yet to be spent. We see growth above average on a global level, and certainly in the US and most major G10 economies through next year, right? So one effect of this disappointing fact that the pandemic's not behind us and we're moving towards endemic is it's stretched out this period of above average growth, right? But that also means above average inflation, because ongoing COVID will continue to cause supply side problems and also continue to keep investor or consumer demand focused more on manufactured products rather than services. Right? So that's a difficult thing. And again, that speaks to the importance right now and next year of central bank flexibility and responsiveness to be able to cope with this. Now, at this point, we are seeing a move to remove monetary accommodation. We're not getting the massive, right, multi-trillion-dollar waves of fiscal stimulus. There's still stimulus in the system. So on the margin, the conditions aren't quite as attractive for risky assets. Now, with above average growth, earnings look good, right? We're in a monetary policy still accommodative overall. We see positive returns to risky assets, equities, commodities, credit, but more volatile, right? And that's going to affect currency quite a bit as well.
Right. So Aaron, with that macro backdrop, what about developed currency for the remainder of the year? And what are your favorite positions for 2022?
Yeah, I mean, right now it's hard to deny it's a great environment still for the dollar, right? So the recent trends will persist. Not only have you had a hawkish shift from Powell this week, strong employment numbers. I know the headline number disappointed on non-farm payrolls today, but the household survey showed almost 1.1 million jobs created. So very strong environment for the U.S. The U.S. does tend to behave U.S. dollar as a safe haven, given its position as a global reserve currency. And so with this heightened equity market volatility and the uncertainty of Omicron, over the next 4 to 6 weeks, at least, we would expect the dollar to continue to be pretty well supported, as well as more defensive currencies like the Japanese yen, Swiss franc, even the euro a little bit. Into 2022, again, we see above average growth and we see a gradual but messy path to improvement with respect to COVID. So I think the dollar rally runs out of steam and we start to look at more of a bearish tone to the dollar, more of a downtrend to the dollar. Right, so the U.S. is leading in growth and recovery. It's more likely to turn the corner and start to revert back to long-term growth averages. It's very expensive now because it came into the pandemic expensive. And although it sold off in 2020, it's kind of climbed all the way back up now. So it is quite expensive. And unlike the past Fed tightening cycle, the Fed's not alone in tightening, right? So we're already seeing rate increases from a number of countries across EM and G10. And a number of central banks are likely to hike more rapidly than the Fed. So we think ultimately that dollar move rolls over. And then we look at, again, still resilient to positive commodity markets. So we like those currencies. Right now, Canada really stands out, benefits from the stability of the US economy, plus the Bank of Canada likely to raise rates. And again, great employment numbers today for them. And the British pound looks okay. Again, it's proven that UK has proven it can handle a high sustained level of COVID cases. We're still seeing positive surprises on retail sales growth. The Bank of England is likely to hike in the next few months, maybe not in December, which will be disappointing temporarily. So we like those. And then we would look to buy dips in weakness as 2022 progresses in other pro-cyclical currencies like Norwegian krone, Australian dollars.
So Aaron, emerging market currency is cheap. Explain why investors should be cautious and selective, and what do you like there?
Yeah, I mean, that's, if you just think from a long-term value perspective, that's where all the value is, right? Particularly in Latin America, most of Eastern Europe, the currencies are very, very cheap. Yields are rising, right? And that's good. Those are the first two things that investors in EM assets look for, particularly in fixed income. It's I want some high yield and I want cheap currency valuations. However, not super exciting yet, right? EM has a tough hill to climb because those yields are high and rising, but relative to inflation, they're still not high enough. So we need to see a little bit more, and we need proof that inflation will start to roll over and be contained without the central banks having to hike so much that they just kill growth and cause a lot of disruption. Investors also like rising EM growth relative to developed market growth, and a good, stable fiscal monetary policy outlook, good, stable political outlook. Those still remain very challenged, right? Debt levels are very high, fiscal balances are stressed. The political calendar, particularly in Latin America, is tough. And EM growth is languishing versus developed market growth, right? You're not really getting that acceleration. So that means you have to be very selective and look for the countries that are cheap and have higher yields, but those other factors aren't a big hindrance. So we like the Chilean peso, particularly with the elections coming up. There's a big political discount in the currency, but growth is strong. Rates are rising very rapidly. Good exposure to copper. Again, we like commodities. We love the long-term copper story with the shift towards EVs and net zero, shift towards net zero. It's a good story for copper. So we like to take this opportunity to buy Chile. It might be pretty scary for the next couple of weeks. Russia, obviously, Ukraine's in the headlines, but Russia has a very dependable central bank, high yields, benefits from stable to stronger oil, and we do have a strong outlook on oil through next year. So that was one of the winners this year, and I think it will continue through much of next year. And then look at some of the beaten down currencies in Eastern Europe, particularly Polish zloty, maybe Hungarian forint as well. And their central banks are finally starting to really get aggressive in raising rates. Growth outlook is strong. I, though, would prefer to trade that maybe against Czech if you're able to do a pure currency trade, or against euro at least, to take away some of that dollar volatility.
All right, Aaron, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you.